Now, welcome back to Iowa Live. Lou and Michelle here. It's time to get smart with your money, Michelle.
That's right. And here to help us do that, of course, Stephanie Bolles with SA3 Wealth. Thank you for joining us here this morning.
Thanks for having me.
Perfect timing for you, young lady, especially with what happened last week. Talk about a roller coaster.
It has been a little volatile.
Yeah, a little volatile.
A little bit.
That's an understatement there. So we saw a drop.
Yes,
last week that
very
was
big gap.
unprecedented, wasn't it?
We had about a 12% decline last year, or last week. Yeah, It was a big drop in the market.
And what normally happens when situations like that arise in your world?
So what basically happens when you have a market decline of 12%, or really what a bear market would be considered is if you have a 20% decline for more than 2 months. So it wasn't quite that extreme.
Okay. So that is the definition of a bear market.
And a bull would be just the opposite, where you have a 20% gain for
increase.
2 months or more.
So it would be safe to say that last year we had a bull market year.
Yep. So we were up, depending on where you were investing in stocks, anywhere from about 25 to 30% on a lot of different equities last year. So we did give a little bit of that back, but having 10% corrections intra-year is not uncommon. Now, we don't necessarily usually see it all in 1 week, and that was kind of an eye-opener. And we had some, extending circumstances with coronavirus and things like that. And we did gain a big chunk of that back again on Monday. We had one of the record gains on Monday in terms of the highest gains in any one day.
Right, and that percentage was what? That nearly
it was about 5%.
5%, yeah.
Yep. And then yesterday, with the Fed cutting about 0.5%, it sent some caution into the markets of, what do they maybe know that we don't know?
Does that freak out the markets when things like that happen? When they say, okay, we're starting to go back up again. Okay, the markets did rise a little bit on Monday, but then all of a sudden the Feds do this. It's like, all right, there is something that we don't know about.
Yeah, they haven't had, the Fed hasn't had a reaction to an emergency per se since the financial crisis. So the fact that we did that again, of course, is going to subconsciously have or consciously have effects on investors.
Okay.
So, but what's important is to really stay focused and look at your long-term patterns. So if your strategies have not changed or your goals have not changed, if you're still not planning to retire for 10, 15, 20 years, or you're not going to be taking that money out for 10, 15, 20 years, these types of changes shouldn't be impacting your portfolios because you're looking more long-term. It's really important that you keep strategies to focus on the time frame within which you need that money out. It's more important to have your timing of the money in the markets than it is timing of getting timing of the markets per se. So if you're trying to use money in the next 3 to 5 years, you should have a different strategy than money you're going to be spending 10, 15 years out. So the money that really is affected by those big declines that we have should be more long-term money anyways that can weather through it. And that's what we say by having its time in the market. Just if your strategies haven't changed, don't react and do market timing per se, because more times than not, people miss that window to get back in. So some of the best gains, like we saw Monday, come right after some of the largest volatile losses. So if you're trying to time in getting in and out, a lot of times you miss that window of when to get back in.
Right.
And it can significantly impact your return. If you just miss 40 days of trading over a 10-year time of trading, that's a very small days of trading. You can significantly take a portfolio that could have been as high as a 6%, 7%, 8% return, and you may end up with a negative return just by missing, a few days a year of the best market performing days.
That's hard to believe.
So it's important, it just really depends on your time frame, what those strategies be. Short-term money should have a very different strategy than long-term money, so that when we do have these volatile days, it's not impacting money that you're spending right now or you're spending in the near future. You can just let it bake and leave it in the markets.
Okay, so what was going through your mind last week when we were taking that decline? What was the mindset that you were going through?
So we are more long-term focused with our spending patterns and saving patterns right now. So I looked as an opportunity to get some extra money that we had on the sidelines in. Will that pay off right away? Probably not. We'll have to sit and let it bake for a little while and use that when we feel like it's a good time for us to use that. I don't have a specific purpose for it, so it really can just sit there as long as it needs to sit there.
Right. Because before it was just sitting somewhere else.
Yeah, it
before,
was
right?
just So we accumulate savings as every family does a little
Right.
bit, and so instead of keeping it in the money market where we had it, we just kind of reallocated a little bit more than we normally do, just for the opportunity that it saw. But what people are doing every day is they're taking advantage of those market volatilities too, with your payroll deductions every time that's going into your 401k. So every time we get a drop, keep in mind that new money going in is buying it at that drop too. So you're buying it cheaper. So if your money went in, sometime last week, you bought it a little bit cheaper than you did the month before.
Oh, I never even thought about that.
So when you're looking at new money going into the markets, those market declines can work in your favor to help buy more shares.
Because you automatically have that money going in, and if
Right.
you already allocated to buy this stock, for example, and it is a lot cheaper, you might, just an extreme measure is you might be able to get 2 shares of stock instead of 1.
Yeah,
And then once it starts going back up, you're the benefactor.
Yeah, and what most people are actually investing in their retirement accounts are mutual funds. So
Right.
you're not heavily dependent on any one company. It's spread out over hundreds of different companies. And then you have somebody professionally picking, what stock should be in the portfolio and those types of things. So mutual funds are more common in retirement accounts, especially with employer-sponsored retirement accounts. That's the most common thing that you'll see. So dollar cost averaging is the concept of just putting the same amount of money in every single period. Sometimes you're going to buy more shares when the markets are down.
Got it.
Sometimes you're going to buy less shares when the markets go up. And really, when you're long-term focused, what you really care about is what you buy it at and what you sell it at. What it does in between is just kind of monopoly money because you're not actually selling it.
It's just numbers on a screen.
Yeah, and if you look at your statement, honestly, it's outdated by the time it comes in the mail because they change every day.
Yeah.
So you want to stay kind of long-term focused. Some of the best things that I would recommend people do is look at your portfolio on a regular basis, because there are times where certain performers are going to do better than others. Sometimes large-size growth companies might do better than small-size companies. And if that was only supposed to take up 10% of your portfolio, but it did really, really well, now maybe it's taking up 12 or 15, you can do what's called rebalancing. And you should be doing that at least once a year is a good strategy. You could do it manually. A lot of places with 401ks and advisors can do that automatically. And what that does is it kind of reshuffles everything back to what your original holdings were.
Oh, okay.
And if you think about it, that goes back to the whole concept of what we want to do when we're investing. We want to sell high and buy low. And what you're doing when you're rebalancing is selling off some of those assets that were the good performers and buying the ones that were underperforming during that period. And that allows you to, one, keep your risk tolerance in check so you don't get overly aggressive maybe with your portfolio, and it also keeps your exposure to the right categories in line too. So rebalancing, dollar cost averaging, meet with your professionals to make sure you don't get skewed off course because you're emotionally reacting to what's going on in the market.
And that's the key, is not to emotionally react.
Correct. Yeah, because then you end up potentially pulling out at the wrong times, and then most of us don't have the right timing to get back in.
How many emotional phone calls did you
What I was
get?
just
We actually did pretty good. I'm very proud of my clients. I did not get a lot of emotional calls. I did get 1 or 2 check-ins of, should we be concerned, or can you tell me how my position's repositioned? But no panic calls, not a
Did
one.
anybody say, hey, let's jump on board, let's get on the train
Yes,
here?
we did get a few calls asking, is this a good time? Is this a good entry point? And, depending on their time frame, it could be. It certainly was buying it cheaper than it was the week before. So
It's like buying stuff on sale.
Yeah, the stock market's the only
Yeah.
place you could have a 20% discount and people are not running in.
That's an interesting way of looking at it.
Yeah.
How about
Yes,
that?
it is.
So if people want to get more information about your services and what you have to offer, how can they get a hold of you?
Yeah, our website, SA3Wealth.com, has all of our contact information. There's also some great resources on there. We would be happy to do a free portfolio analysis for people if they're worried about, how should they be moving
during these
going forward.
times is
Is
when
when you
you
It's always
really-
good to have a
yes.
check-in. Yeah.
Wonderful. Well, great job as always.
Thank you.
Thank
Yes,
you so
thank
much
you.
for being here. There's the phone number. Give them a call and just get a little peace of mind. That's what we suggest. It is